Welcome, everyone, to the March edition of the Miller Johnson Employee Benefits Practice Group Benefits Lunch Break webinar. My name is Brett Liefbroer, and I'll be bringing you through the webinar today. And just as a reminder to you before we get started, the 2024 webinars that are upcoming, you can see the dates here on the slides. Please feel free to register for these. There's always valuable information to be shared, and if there's any breaking news, we will also cover that in these webinars. If you have any upcoming topic ideas about what you'd like to hear about, please share it with us in the Q&A or the post-webinar survey, and we'll do our best to accommodate that. The topic of today's webinar is the latest updates on employer-provided educational assistance programs. So educational assistance programs are programs that are available under Section 127 of the Internal Revenue Code. And as a brief overview of these allow employers to reimburse their employees for certain educational expenses up to a maximum limit per year. And the latest update regarding these programs is the existence of temporary relief that now allows for the tax-free reimbursement of qualified student loans through the end of 2025. And that is a new change that came about back in 2020. And a second related topic that goes hand in hand with discussions of educational assistance programs are working condition fringe benefits under Section 132 of the code. And specifically, there's one fringe benefit known as job-related educational expenses, which can be deducted on a tax-free basis under Section 132 of the code. And the definition of job-related educational expenses, as we'll see later in the webinar, is much narrower than the definition of which expenses can be reimbursed under a Section 127 plan. So we'll start today with the educational assistance programs. So Section 127 of the Internal Revenue Code permits an exclusion from an employee's gross income for amounts paid or expenses incurred by an employer for educational assistance under a qualified educational assistance program. And we'll go through in greater detail the requirements that need to be met to be a qualified educational assistance program. So two preliminary points here. There needs to be a separate written plan established and maintained by an employer in order to have a Section 127 plan. And that plan needs to be for the exclusive benefit of the employer's employees, and it needs to provide educational assistance. So to elaborate a bit more on those requirements, the first one here is one that many employers may not be aware of, but there needs to be a separate written plan in order to have a qualifying Section 127 plan. And that plan may only provide educational assistance benefits. So for example, if an employer wanted to have one plan that, say, provided educational assistance benefits and group healthcare benefits for some reason, that would not be a qualifying Section 127 plan. The plan may not provide benefits to an employee that exceed the statutory limit for a calendar year, and we'll cover what that limit is on the next slide. And the plan may only benefit the employer's employees. So under a 127 plan, an employer may not reimburse on a tax-free basis the benefits of an employee's spouse or dependents. And another requirement for these plans is that employees who are eligible to participate in the plan must be given reasonable notice of the program's terms and availability. And this is accomplished simply by providing your employees with a copy of the separate written plan. The plans we draft here at Miller Johnson generally are only about 5 to 6 pages and are digestible by employees to give them reasonable notice of the program. So the maximum exclusion amount that is allowed under a 127 plan is $5,250 of educational expenses per calendar year. This amount is not indexed for cost of living adjustments. So absent any legislative action, this amount will remain at $5,250. And as some brief history related to this amount that I found interesting is that this amount was actually originally created by Congress all the way back in 1978. And the amount has not changed since 1978. So as you can imagine, that may have gone much further in terms of educational expenses over 40 years ago than as compared to now. But it is still a valuable benefit that many employers offer, and employers who don't offer it may want to consider offering. So if an employee is provided educational assistance benefits of more than $5,250 during a calendar year, that is permissible. An employer can provide more than that amount, but the value of those excess benefits will generally be taxable income to the employee, unless they're excludable for some other reason, such as qualifying as a working condition fringe benefit. So here's an example. An employer's Section 127 plan reimbursed an employee $8,000 during a calendar year. $5,250 may be reimbursed tax-free, and $2,750 would be treated as taxable income to the employee. So how is educational assistance defined in terms of these 127 plans? It's defined as tuition, fees, and similar payments, as well as books, supplies, and equipment. The exclusion is available for graduate level courses. It's not just undergraduate courses or other training. And under these plans, qualifying educational assistance is generally not limited to courses that are part of a degree program. So in general, courses may be reimbursed even if they are not part of a degree program. And on the next slide, we'll address one of the circumstances when the course needs to be part of a degree program. So here are examples of educational assistance that does not qualify as qualified educational assistance eligible for reimbursement. Tools or supplies other than textbooks that an employee is allowed to keep after completing a course of instruction is not reimbursable on a tax-free basis. So let's say an employee is taking a shop class and he purchases a new saw in order to complete some of the assignments required by that course. If that employee can keep that saw after that shop class, that would be considered a tool that the employee was able to keep, and that could not be reimbursed on a tax-free basis. Educational assistance does not include meals, lodging, or transportation. And in general, educational assistance does not include benefits in connection with any course or education involving sports, games, or hobbies. These education involving sports, games, or hobbies, essentially gym class, is only reimbursable on a tax-free basis under a 127 plan if that course involves the employer's business or if that course is required as part of the degree program. And here is the latest update with respect to 127 plans, and that is the exclusion of employer payments for student loans through 2025. So in response to COVID-19, back in 2020, the definition of educational assistance was temporarily expanded to include an employer's payment of principal or interest, whether directly to the employee or to the lender, on any qualified education loan. As originally enacted, the relief was set to expire at the end of 2020, but the relief was extended now through the end of 2025. And since this relief has been extended at least once, there is a possibility that this relief could be extended again for qualified student loans paid beyond 2025. We'll just have to wait and see if that legislation comes through, and it may depend on how popular this benefit is. So what is the meaning of qualified education loan? A qualified education loan means any debt incurred by an employee solely to pay qualified higher education expenses that are incurred for the employee's education, paid within a reasonable period of time before or after the debt is incurred. So there is guidance out there that says this requirement is met if the debt is incurred either 90 days before a semester starts or 90 days after a semester starts. And that is just guidance. There may be other arguments out there for when the debt was incurred. And the loan must have been attributable to education furnished during an academic period that the employee was an eligible student. And in order to be an eligible student, that means you must have been a student who was enrolled at least half-time in a program leading to a degree, certificate, or other recognized educational credential. And qualified education expenses. So this is why I underlined the term solely on the previous slide. So if I take out a loan as a student and it's not solely for these listed items here on the slide, that entire qualified education loan can be considered tainted, which means that that qualified education loan would not be eligible for tax-free reimbursement under a 127 plan. So for example, if I had taken out a loan during law school and I could use it for any purpose, so I use a bit of it for room and board, tuition and fees, but I can use any excess for any other purpose, such as entertainment expenses. Let's say I want to go to the movies and I use some of my student loan to do that. I have now tainted that student loan and I cannot have that loan reimbursed under the 127 plan. A common question employers have then is, how will I know if my employee's loan is a qualified education loan? And in order to accomplish that, we recommend preparing an attestation form where the employee essentially attests that his loan was used solely for these listed education expenses on the slide. There are non-discrimination requirements applicable to Section 127 plans. The plan for any program year, not more than 5% of the amount may be provided to individuals who are more than 5% shareholders or owners. And in order to be non-discriminatory, the program needs to satisfy certain tests regarding how many non-highly compensated employees benefit under the program versus highly compensated employees. If an employer is concerned that too many highly compensated employees may be participating, that's when you would want to consult with an attorney to see if this test is met. So it would be a red flag. For example, if an employer set up a 127 plan and only the CEO, who is a highly compensated employee, was eligible to participate. So just to give you some examples of the dollar thresholds to be highly compensated employees. For 2024, an employee who earned more than $150,000 in the preceding year, so in 2023, would be in HCE in 2024. And for 2025, an employee who earns more than $155,000 in the preceding year, which would be 2024, would be considered an HCE in 2025. So that highly compensated employee threshold is adjusted over time. There are many optional design considerations that can be included. These are put into the optionally put into the written plan that's prepared for the Section 127 plan. 127 plans in general are not subject to ERISA. So ERISA's claim and appeal procedures generally do not need to appear in the terms of a 127 plan. But an employer may choose to include appeals procedures just so employees have some way of essentially appealing a decision if they feel that they should have been eligible for benefits. A 127 plan can include minimum performance standards for the employee. So if a employer wanted to include a provision that states that an employee will only be reimbursed under the 127 plan if the employee attained a grade of C or better, an employer could put that provision into the plan, but is not required to do so. Certain restrictions can be put into the plan. For example, if an employer only wanted to reimburse education expenses for full-time employees, an employer could do so. Or if an employer only wanted to reimburse up to 2 courses per semester, being mindful of that statutory limit, that is permissible as well. An employer can also include repayment obligations. So if, for example, if an employee leaves after 1 year after receiving the reimbursement, the employee has to pay back 2/3 of the benefit. The employee makes it 2 years after the reimbursement, only has to pay back 1/3 of the benefit. If the employee reaches year 3, the employee does not have to repay the benefit at all. And Miller Johnson can help draft these 127 plans, and we can walk through and explain, which provisions are required and which provisions are optional. Moving on now to working condition fringe benefits. So starting at a high level here, working condition fringe benefits in general are a form of compensation that employers can offer to their employees in addition to employees' regular pay. So some examples would be no additional cost services. So let's say the employer is a hotel. It has several rooms that have not been rented out and are not going to be rented out. An employee could stay at the hotel. That would be no additional cost to the hotel, and that would be a working condition fringe benefit that would not be needed to be included in that employee's taxable income. Qualified employee discounts can be working condition fringe benefits. This would be a discount on something that the employer would typically sell in that employer's line of business. So let's say an employer, is in the business of selling toothpaste. If the employer wanted to sell its toothpaste to its employees at a discount, the employee would not have to include that discount in taxable income. De minimis fringe benefits do not need to be included in taxable income. This would just be small items, coffee, donuts, soft drinks. The key with this one is that these need to be non-cash gifts. So if you give an employee a gift card, you would automatically fail to be a de minimis fringe benefit. So cash or gift cards, those will not qualify as de minimis fringe benefits. And the primary focus here for the rest of the presentation, job-related educational expenses can qualify as working condition fringe benefits under certain circumstances. So these expenses can be fringe benefits under Section 132 of the code. As mentioned earlier in the presentation, this is a narrower and more difficult definition to meet for what's reimbursable on a tax-free basis than under Section 127 of the code. However, the upside of 132 of the code is there is no statutory limit per calendar year. There is not that $5,250 limitation here. If the benefit qualifies, it can be reimbursed tax-free up to any amount. In general, these need to be expenses incurred for educational instruction that improves the employee's job-related capabilities. And it does include certain related travel and transportation costs. And there's basically a two-step test here that I'll cover on this slide and the next slide. And the first step involves meeting one of these two requirements. So this first step has to be passed before you continue on to see if you satisfy the second test. So to be excludable, the education must either be required by the employer or by law for the employee to keep his current salary status, job, and education, or which the second prong here, which should be fairly easy for employers to meet, is the educational expense must be in order to maintain or improve the employee's on-the-job skills. So that one will often get you through this first step. And the second step here is where a lot of these expenses will not qualify as job-related educational expenses. The education may not be required for the employee to meet the minimum educational requirements of the employee's current job. So if an employer has a job posting or requirement that a employee, for example, needs to have a degree in accounting, a bachelor's degree or an associate's degree in order to fill that role or be in that job, that those educational expenses are not eligible for reimbursement under Section 132 of the code. The job-related educational expense may not qualify the employee for a new trade or business. So this will knock out a lot of educational expenses because this requirement would probably knock out most degree programs. So an associate degree, bachelor's degree, graduate degree, there's a strong argument there that the attainment of one of those degrees would allow an employee to enter a new trade or business. There may be arguments on the other side for degree programs. So let's say an employee achieved his bachelor's degree and that employee is going to work for an accounting firm. You may be able to argue that that degree did not qualify the employee for a new trade or business. But that would be a point where there's arguments on both sides, and you'd want to have a discussion with your attorney before you decided to, or your tax advisor, before you decided to reimburse that expense on a tax-free basis. One common job-related educational expense that is reimbursable on a tax-free basis would be your standard run-of-the-mill continuing education. So let's say you're going to a tax conference or a human resources conference, and you work in a role where that conference would benefit you. That probably will be a working condition fringe benefit. It's one conference. It's not going to qualify you for a new trade or business. And it does improve your on-the-job skills. And as seen in the previous slide, that would get you through the first hurdle here. And if it's just one conference, even one course, you know, you're not pursuing a full degree program, but you're taking one course, that probably will not qualify you for a new trade or business. You'd have a strong argument there that that is reimbursable as a working condition fringe benefit under section 132 of the code. And as I move to the questions slide here, I did receive a number of questions submitted to me before the webinar. And since I don't see any questions in the chat, I will just go ahead and go through some of these questions that I received. So the first question is, does this do these rules apply to educational certifications, job field specific courses, continuing education, associate, bachelor's, postgrad? So as I discussed on the previous slide, continuing education, one-off courses, certifications, those are more likely to be considered reimbursable as a tax-free basis under 132 of the code. Those expenses would definitely be reimbursable under a 127 plan, up to the $5,250 max. But as you move towards these degree programs, associates, bachelors, et cetera, that's when you're no longer qualifying under 132, but you may qualify under 127. Another question is, how would using the Michigan Going Pro Training Fund to pay for courses that are part of a program play into this? So this Going Pro Training Fund is a program offered in the state of Michigan where the state will actually provide a grant either directly to the employee or to an employer for that employee to take a certain approved education. So the general rule here is that the payment would be considered taxable to the employee, but it appears that expenses under this fund or these grant programs would be reimbursable under a 127 plan. But you'd have to take a closer look and go through the requirements of the 132 code section to on a case-by-case basis to see if they would qualify there. And there is another section of the code, section 117, which deals with tax-free grants and scholarships. It's possible that these expenses could qualify for tax-free treatment there, but that is outside the scope of what we were covering today. But I can at least mention that to be tax-free as a grant or scholarship, the individual would have to have been a candidate for a degree program when that employee received that amount. So I do see a couple questions in the Q&A now, so I'll go through a couple of these. If a school administrator works toward an educational specialist degree, is any reimbursement over the $5,250 taxable in that calendar year? It's improving their skills, but not necessarily giving them skills for a different job. So it would really depend on, I would say the job description for the school administrator role and whether attainment of that education specialist degree would allow that employee the access to a job that he or she may not have access to before. And the problem with these degree programs is that often is the case with degree programs. Again, it would be a very fact-specific analysis, but if there is some job out there that the employee could not have performed before, but now is able to perform, then it would not be a 132 fringe benefit. All right, another question I received is, the state has recently approved funding for student loan forgiveness for some K-12 employees. The fund passes through the public schools to the K-12 employees. How does that coincide with Section 127? What are the legal issues we should be aware of? So here, it's important to keep in mind that student loan forgiveness is a separate topic than student loan reimbursement. So forgiveness of any loan, including a student loan, would generally be considered taxable income to the employee. And I use the word generally there because there is temporary relief out there right now, which was passed as part of the American Rescue Plan Act, where student loan debt that's forgiven between January 1st, 2021 and December 31, 2025 is not included in taxable income. So there is some, if that student loan forgiveness occurred in that time period, there is a argument there that that amount would be reimbursable on a tax-free basis. Okay, another question here. What if an employee has a position eliminated or is asked to leave an organization? Does the company have full liability for reimbursement? If it has been approved but not paid yet, or already paid and not met the plan terms of 1 to 3 years. So here you would want to look carefully at how the repayment obligation was described in the written plan for the Section 127 plan. So I have seen plans drafted where the repayment obligation only applies if the employee voluntarily leaves employment. So if the plan is drafted that way, that expense would still be reimbursable under the 127 plan, because the employee is involuntarily leaving the organization. And I will take one more question here. So we have, this question states that we have an educational reimbursement program currently. Would it be recommended that if we make a move to offering an educational assistance program for the reimbursement program to be discontinued? So I interpret this question to be stating that there's just a general educational reimbursement program in place for that employer. What I would recommend here is having an attorney review that existing educational reimbursement program. And if it's only missing a few elements in order to to be a qualifying Section 127 plan, the reviewing attorney could probably modify that existing educational reimbursement program, put in any missing required elements in order to convert it into a Section 127 plan, a qualifying plan. And I would say that the existing program would not need to be discontinued, but the plan could be amended in order to be a qualified educational assistance program. So with that, I will conclude today's lunch break webinar. Please join us for our next one on May 15th. Thank you.